The Korea-US benchmark interest rate inverse. The Federal Reserve, the Central Bank of the United States, raised its key interest rate by 0.75 percentage points on July 27th local time. Raising the base interest rate by 0.75 percentage points at the time is called the Giant step. The Giant step is the second after June. Fed Chairman Jerome Powell said inflation is so high that a big rate hike at the next meeting may be appropriate. It hinted that interest rate would continue to rise for the time being to keep up with the high inflation. The U.S. benchmark interest rate rose from 1.5 to 1.75% to 2.25 to 2.5% with this hike. It inverted Korea's base rate of 2.25%. It is the first time in about 2.5 years that the US base rate has been higher than that of Korea. As the Korea-US benchmark interest rate inverse, there are concerns that foreign funds could escape from the Korean stock and bond market. This is because foreign investors have less incentive to roll money in Korea, where interest rates are lower, but historically, money outflows have not been very noticeable. The first period of US interest rate increase was from June 1996 to May 2000, and the second period from June 2004 to June 2006, and the third period December 2015 to December 2018. In the first period, the period when the US interest rate was up to 1.50 percentage points higher continued for 6 months. The maximum reversal of the second and third periods was 1.00 percentage points and 0.875 percentage points. However, all foreign securities were net inflows during each interest rate inversion period. In the first period, it was $16.87 billion. In the second period, $30.45 billion. And in the third period, $40.34 billion, etc. Experts are more concerned about the negative impact on the economy from the US interest rate hike than the rate inversion between Korea and the US. This is because if the US economy is shaken due to fiscal austerity, it will adversely affect Korea's exports, which are already showing signs of slowing. There is a possibility that US tightening may act as pressure to raise the domestic interest rates. The Fed's absorption of liquidity could lead to a stronger dollar, which could further depreciate the won. A decrease in the value of the won means an increase in the won-dollar exchange rate, which is a factor that increases the rise in import prices. This may adversely affect the Korean economy. Judging from these precedents, the stock market and foreign capital inflows and outflows did not proceed in a consistent direction at the time when the Korea-US interest rate inversion occurred. Predicting the future is not that easy.